Most everyone knows the power of dividend investments, where the right ones can snowball and grow your wealth quicker than a dog spotting a squirrel in the park. However, there are over 9,000 exchange-traded funds, or ETFs, worldwide, and only a portion of those lean in on dividends. And a person certainly doesn't need to invest in every single one. We just need to bring the top options to the surface to make the best investment decisions. And that's why I plan to review the top 5 dividend ETF a person can buy and hold
forever.
And by forever, I really mean until you've reached platinum status in life, where you can prioritize your free time over everything else and do whatever you want, like traveling overseas, playing 18 rounds of golf on a Tuesday, day drinking with fruity cocktails in the Caribbean, or play video games all day long. Hey, there is no judgment here. I retired at 46 just so I can make YouTube videos on how I made my wealth. I am the last person on earth that should criticize anyone on how to spend their retirement. In this video, my goal is to review 5 dividend ETF where you could have all of them in your portfolio to help make you wealthy. And my main criteria for judging them comes down to 4 points. And the first is historical performance. Clearly, we want to make the most money that we can. And the second is that the fund must have positive price growth, not just dividend growth. This ensures that we aren't just looking at dividend traps that are losing overall value over time. And the third item is that none of these funds overlap with one another more than 50% based on their holdings. There's really no point in having several funds that are identical to one another. And make certain to stay to the very end of the video to see the overlap between these funds. And the last point is that each one of them has a distinct strategy for their dividends. And this is the part that you're going to want to pay close attention to, because this ensures that all 5 funds are potentially worth having. Now, I do want to take a moment to acknowledge the fact that most all the investments that I speak to in my videos are ones that I am either researching for my own portfolio or they're ones that I already have. But that doesn't mean that they're necessarily the best for you, nor do I want you to feel like I'm pushing any of my opinions onto you. I try to provide the facts on what's available along with the strategies that I'm using so that you can better understand what my mindset is. Your list of go-to dividend ETFs may be completely different than mine, and that is perfectly fine. And if that's the case, please share any other dividend ETF that others may want to know about in the comments below. And just like most of my videos, I do have a spreadsheet linked in the description to all the ETF that I discussed today, along with all of the funds that really didn't make the cut. With that said, let's talk about the first dividend ETF from Amplify CWP Enhanced Dividend Income ETF with the symbol DEVO. And literally every time that I say that, I can't help but think of the 80s band with the goofy hats. As far as the fund, the strategy behind it is to generate 4 to 7% of its income from dividends and option premiums. The manager writes call options on the top 25 outperforming companies within the holdings, which all come from the S&P 500. This is meant to provide downside protection from the buy right strategy, but it also stunts some of the upside growth within the stock. And because of the call options, this fund sets itself apart from most other dividend ETF. And in looking at the holdings, I don't think anyone would flinch from looking at the top companies for this fund, seeing as how they're all well managed with solid financials over the years, from the likes of Microsoft, Caterpillar, Walmart, and Visa. And in digging deeper, we see this fund has the highest expense ratio of the group at 0.56% due to how actively managed the fund is within its call options. And the dividend yield is at a respectable 4.6%, which is one of the highest of the group. Now, when we look at the performance, the trailing 12 months, referred to as TTM, it has the price up over 7%. The dividend growth nearly 2.9%, and the total return is just over 12%. It is extremely important that you look at the price and the total return of a fund. If the fund happens to have a negative price return, but the total return is positive, that means that the dividend is what's keeping the fund's head really above water. I try to personally stay completely clear of those types of funds. Now, I am listing the growth of the dividend, and that is less important to me because that indicates if the dividend payout is growing or declining. And so long as it isn't in an extreme decline, then it doesn't really worry me too much. And I do have an example of that later on. As for this fund at the 3-year CAGR, or compounded annual growth rate, its price growth was low, which was true for most all stock in the past 3 years. But thanks to the dividend, the total CAGR was over 7%. And when we look at the 5-year return, the total CAGR was over 11%, and that's really not bad given the past 3 years. And over the past couple of years, the market has had some serious ups and downs, where dividend investments tend to do much better than growth and technology stock during those hard times. And as a quick side note, gold is another investment that has consistently been steady during recessions. And in looking at this chart, you can tell that gold can hold its own with the S&P 500. Which brings me to today's sponsor, Nevada Canyon Gold, which saw its stock go up over 77% in the past year, where they are not indexed to gold, but rather they build their equity from royalty interests, precious metal streams, and exploration accelerators. They operate solely in Nevada, and they facilitate capital investments with up-and-coming miners and prospectors. Nevada Canyon Gold has the expertise to guide others that own all that expensive capital expenditures to earn and mine more resources. This model is extremely lucrative for Nevada Canyon Gold because they aren't heavy in debt for all of that expensive equipment in this particular industry. They just support others that do. If you're interested, please feel free to check them out in the link below. Let's move on to the second fund of VanEck Energy Income ETF with the symbol EINC. I believe this fund will seem completely foreign to many of you, and honestly, I think that's a good thing. Because the strategy behind this fund is to target MLPs, where MLPs are master limited partnerships that are a pass-through entity, so it isn't subject to corporate taxes. These are typically associated with resource-related companies including gas, oil, coal, and timber. And as a frame of reference, MLPs tend to perform better when interest rates are low, so this is a fund that you will look to have more upside in the next couple of years. But first, let's look at the holdings where you can quickly see those key resource-focused companies like ONEOK, which is a company that engages in gathering, processing, transporting, and storing natural gas in the Midwest part of the country. And they've been in business for over 100 years. This sort of story is similar among many of the holdings for VanEck's Energy ETF, where I don't recognize any of these names, yet they've been around for decades. So let's look at the expense ratio, where it is fairly high at 0.46%, and the dividend yield is a solid 3.61%. But I do want to point out that when you look at the dividend yield prior to 2021, it was substantially higher when the interest rates were lower. And that's just something to be mindful of for the future for this fund. Now let's look at the performance where the trailing 12 months for both the price and the total return have been on a freaking tear, given that this is a fund made up of mature companies. And I love that the 3-year total return is over 18%. This is part of the beauty of this fund because it's overperformed at a time when growth stocks took a major nosedive. And when we take a step back and look at the 5-year, it is a little interesting that the price of the fund had a compounding annual growth rate of only 3.7%, but the total return was over 9% for the CAGR. Now you may be freaked out by seeing the dividend CAGR being negative, but keep in mind that this is the growth of the dividend yield. So when we look back at the chart with the dividend yield over time, you see that it took a severe drop once interest rates began to skyrocket, which explains the negative growth in the dividend yield. Once again, it's definitely just something you want to understand why it occurred and how the fund may change in the future. Now we'll look at the Schwab US Dividend Equity ETF with the symbol SCHD, and it is probably one of the most popular dividend ETFs available. And with good reason. It is the hallmark of the best-in-class dividend-paying equities, where the managers ensure that only companies with a long track record of dividends and dividend growth can be in the fund. And that is painfully obvious when you look at the top holdings of companies like Lockheed Martin, Chevron, Pepsi, and Coca-Cola. Okay, not to stir the pot too much, but in the comments, let's hear it. Which is best, Coke or Pepsi? Hey, I'll even kick it off, and I'll share my favorite as being cola or pop is so refreshing on a summer day. It's also refreshing when you can press that like button to allow my channel to be shared out more broadly. And I'd love it if you'd consider subscribing to be up to date with all of my latest content. Now getting back to SCHD, it has the lowest expense ratio of the group at 0.06%, and the dividend yield is a solid 3.53%. Now looking at the performance of the fund, the trailing 12 months, 3-year, and 5-year are all quite respectable at both the price CAGR and the total return. And this is why it is one of the favorites of the group, and analysts are also forecasting it with an average upside of over 13%. Honestly, I have nothing more to add to this fund. It is popular for all the right reasons. Now on to the next popular fund of JP Morgan's Equity Premium Income ETF with the symbol JEPI, where its strategy is similar to 𝐓𝐨𝐩's fund, where it is actively managed selling options to generate additional income. The difference between the two is that JEPI has a lot more holdings and they generate nearly double the dividend yield as the 𝐓𝐨𝐻 fund at a much lower expense. But JEPI hasn't been around for very long, so they have a very limited track record. And please keep in mind that I'll be showing the overlap in holdings among the funds at the very end of the video. As for JEPI, its top holdings range from top companies like Progressive, Amazon, and Train, where the JEPI expense is really middle of the pack at 0.35%, and the dividend yield happens to be the highest of the group at 7.68%. Now let's jump right into the performance, where the trailing 12-month total return is good at just over 11%, and the 3-year total CAGR is just over 7%. And a weakness for this ETF is that the fund price CAGR is negative 1.37% over the 3-year, and that does go against one of my top criteria listed at the beginning of this video. But given its popularity, I felt it was important to share this fund so you can see how it compares among all of these other funds. Technically, it shouldn't have even made my list, but now you can see how it has some similarities to the 𝐓𝐨𝐻 fund, and you can make the best decision for yourself. Now on to the next fund of WisdomTree US Quality Dividend Growth Fund with the symbol DGRW. And I believe that many of you may be familiar with this fund, where its strategy is to focus on the forward-looking earnings estimates with the historical return on assets and the return on equity growth for its selection. So it's more of a mix of dividends along with growth, which makes it more of a hybrid dividend ETF, which I think is quite evident when you look at the top holdings of companies like Microsoft, Apple, P&G, and Coca-Cola. Like I said, it's more of a hybrid ETF of both growth and dividends, and it happens to have expenses that are lower than the average at 0.28%. But in turn, the dividend yield is the lowest of the group at 1.68%. And when we look at the performance, it is rocking the past 12 months with a total return of 20%. And the 3-year CAGR for price and total are pretty good given the challenges of the past few years. And the 5-year CAGR is the best of the group for the total return at nearly 13% compounded annual growth. And this fund has analysts the most excited from amongst this group, with an average forecast of nearly 14%, which happens to also be the highest positive sentiment among the funds today. Now I want to look at the overlap of all the funds with regards to their holdings, where you can see the greatest overlap is between 𝐓𝐨𝐻 and DGRW at 28% overlap in weight of holdings. Then it's JEPI and DGRW at 25%. Then it's SCHD and DGRW at 22%. From here, there is very little overlap between the other funds. In fact, the EINC fund, or VanEck Energy Income ETF, has 0 to no overlap with most of the other funds. Now, if you're the kind of person that's more interested in ETFs that pay you a monthly dividend, then you'll want to check out this video right here. Thanks so much for watching.